that partnership as we go to the Congress in Portugal later this year. The only other thing I want to do as part of the introduction is to thank Procopio, who is our host here in Orange County. Paloma, who's on the end of at the end of the table, working the slides. She is one of my on the steering committee for the Southern California chapter, and we're happy for Procopio to host us here. And then also thank you to Lee and Co, who are hosting us there in Seoul. So with that, all I would say is welcome. This is a first time event, which we hope will be a model for other collaborations between other countries and other chapters around the world. So thank you for joining us on a maiden voyage for IFA.
Thank you, Michael, for introductions. And now let's turn to Korea side. Let me briefly introduce Mr. Seok-Hwan Kim, the president of IFA Korea. Mr. Kim brings a wealth of experience across academia, government, and legal policy. He currently serves as a professor of the tax law at Gangwon National University and has held several prominent positions, including research judge at Korea Supreme Court, non-standing adjudicator of the tax tribunal, and a member of the Ministry of Economy and Finance Tax Policy Advisory Committee. He also formerly served as a chair of the Korean Association of Tax Law. Please join me in welcoming President Kim.
I'm Seok-Hwan Kim, introduced by Mr. Steve Mino Kim. As the president of IFA Korea, I am very pleased to host today's seminar, joint seminar between IFA Korea and IFA USA, Southern California. I'd like to thank everyone who attends today's event in person or Zoom online. I'd also like to thank Mr. Mike Lebovich, the chairman of the IFA USA Southern California, and everyone who sincerely prepared this event in both sides of the Pacific Oceans. With the prospects of the international taxation area so uncertain due to the relaunch of the Trump administration, I'm sure that today's seminar would be very timely and very helpful chance we can learn a lot. I heartily hope this kind of academic exchanges between the two IFA branches would continue even in the future. I hope all of us will have a wonderful time today. Thank you very much.
Thank you, Mr. Seok-Hwan Kim. Thank you again to both IFA chapters for setting the stage so thoughtfully. We now begin session 1, which will address international tax policy in Trump administration and the key factors Korean investors should consider when making a critical decisions on outbound investment into the United States or inbound into the United States. Leading the session is Michael Lebovich, this time in his role as a presenter and the policy advisors. After Michael's presentation, I would say a lecture is more appropriate. We'll move into the panel discussion with the perfectly positioned panelists from both US and Korea. Let me briefly introduce 3 panelists from session 1. Bumsu Kim will be joining us from the KPMG Irvine office. With over 13 years of experience, he advised multinational companies and private equity funds on a wide range of the U.S. federal and the cross-border tax matters, including M&A, tax due diligence, transaction structuring, and the applications of the tax credit under the Inflation Reduction Act. Having advised numerous Korean companies on their inbound investment into the United States, Bumsu is exceptionally well positioned to share valuable insight during this session. Next is Jae-young Lee. Jae-young Lee is a partner in the tax practice at Yutron LLC and a member of the firm's German desk. She's duly admitted to practice law in Korea and California. Ms. Lee has broad experience in litigation, tax, customs, and other disputes before Korean courts and regularly advises high net worth individuals and corporate clients on cross-border legal and tax matters involving Europe and the United States and Asia. Last but not least, we have Hyo-won Lee, senior foreign attorney at Shin & Kim. She focuses on the U.S. tax policy, international taxation, and tax dispute. Before joining Shin & Kim, she worked at the IRS Office of the Chief Counsel and spent 6 years at a major international law firm in Washington, D.C., advising multinational corporations. With experience in both the U.S. and Korea, she's perfectly positioned to share valuable insight during the session. Now, without further ado, let's turn to our presenter and panelists for their insight. Michael, the floor is yours.
Great, thank you. Just give us a second to load those slides here.
You're already in. Why? Yeah. What happened to the meeting? We got kicked out. We got kicked out.
Oh, hold on. We're having a little technical difficulty here. Actually, maybe what I'll do is I'll just go ahead and start and we'll figure out how to get the slides working here. But what we want to talk about with respect to the first panel is just some observations with respect to international tax policy in the United States and how that will resonate with respect to Korean investment here in the United States. And so what we'd like to talk about are a couple of points. First, just give an overview on, I think what everybody is aware of on the status of US tax reform and the US tax reform process. And then we'll spend a little time talking about President Trump's big, beautiful bill, as he likes to call it. Instead of Build Back Better, 3Bs, this is a big, beautiful bill in typical Trump fashion. But then we'll talk about the business tax provisions that are critical and the impact of some of the expiration of the TCJA tax provisions. And then Jae-young and Hyo-won will talk about the impact of Pillar 2 on Korean companies. And then we'll talk about some challenges and some opportunities with respect to Korean investment in the United States. So first of all, just to start, so this 2025 and 2026 will probably be one of the most consequential years of tax reform in the United States, as consequential as 1986. So here in the US, as you probably are all aware, we operate under the Internal Revenue Code of 1986. And in 1986, that was the last time we had a major tax reform. 2025 will be as consequential and probably more consequential than that. But we in the US, because of our political our political polarization, we are forced to enact tax legislation in a very unique way, and that is through this budget reconciliation process. So ordinarily, when a bill makes its way through through Congress, It gets, it's voted on by one house, either the House or the Senate. And tax legislation ordinarily would need to be originated in the House, approved by the House, make its way over to the Senate. Those versions would generally not align, and so a conference committee would then be appointed to work out those differences. In a normal legislative process, any party, unless a party has more than has 60 votes in the Senate, any party can generally block that process. And so now, since the no party controls more than 60% of the Senate, tax legislation needs to make its way through the process through what's called reconciliation. And so reconciliation essentially means that through the budget process, the budget committee lays out a set of budget parameters that says, okay, Congress, you can enact legislation within these parameters, within these budget guidelines. And as long as you do that, and as long as the legislation relates to taxing and spending, then you can pass tax legislation with a simple majority. And you don't need 60 votes to move the bill through Congress. And so that budget resolution process passed on April 10th. And so the House and Senate budget committees agreed a resolution that said, that basically gave Congress essentially $5.3 trillion to work with respect to tax legislation. And we're going to talk about how, and all of our discussion over the next 10 or 15 minutes will relate to how Congress uses that $5.3 trillion. What you need to know when you're looking at that number, and it seems like a big number, but in the US, that's not a big number. But just the extension of the Trump tax cuts, the extension of those, and that is, as we'll talk about, that is President Trump's primary objective. If there is anybody that has an objective of extending the quote unquote Trump tax cuts, it's somebody named Trump. And so that is his primary objective. Well, extending the Trump tax cuts alone costs $4.5 trillion. But that's not the end of the objectives that President Trump has. But now that the budget committees have agreed a $5.3 trillion number, the House and Senate tax writing committees can go to work to start crafting legislation. The objective is for Congress to enact a tax bill by July 4th. It was originally going to be Memorial Day, May 30th, an equally patriotic day. Now the target date is July 4th, Independence Day. And you will see, much in the same way as the tariffs were announced on Liberation Day, the objective is that the tax legislation the goal is to have tax legislation signed by July 4th. We'll see whether that's a possibility, in part because even the Republicans are not aligned on their tax objectives.
Michael, if you don't mind, we can share the slide from our side.
That would be great.
Yes.
Yeah. So yes, this is a maiden voyage. Again, we're learning as we go here. All right. So just Steve, tell me when you're sharing.
Want to turn to a specific page of your slide?
Just go to slide. Go to slide 6.
Slide 6. Okay.
Oh, okay. I'm sorry. Go to 5.
Yep, can you go to the slide 5, please?
Yeah, go to. Perfect. So, so Bumsu now is going to talk about some of the important provisions that are expiring. And these are just, the important thing to note here is that these are the business provisions. And these are generally tax increases that were put in place in order to finance the Trump tax cuts in 2017. But these are the expiring business tax provisions which will be relevant to Korean investment in the United States. So Bumsu is going to go over those.
All right, perfect. Thank you, Mike. Hello, everyone. This is 범수. 안녕하세요, 김범수입니다. I think I'm going to assist Mike just to explain a little bit about expiring TCJA business tax provision. So this was the biggest tax reform I remember from U.S. tax history ever since I started working and serving the clients in the professional tax business. And I know from my Korean days, I know there was tax reform every year in Korea. And now here in the US, I remember TCJA from 8 years ago was the biggest tax reform that was made. And now it's 8 years later now, this year, it's going to expire, some of them, and we're going to focus on some of the business tax provisions. So first one is the 163J interest deduction. So a lot of time, Korean investors or even any other investor, shareholder loan or mezzanine loan, they use the loan vehicle to invest in the US businesses. And there are some 163J interest deduction limitation rule. And I think it was EBITDA, 30% of EBITDA prior to 2022. It changed to 30% of EBIT starting in 2020. January 1st of 2022. So it has already been effected, but there's no much more expiration of it, but it's just a change of a TCJA provision. The other one is a BEAT raise. It's a base erosion anti-abuse tax. So this is kind of like works like a minimum tax. So it's new to the foreign investors. If there is a modified base erosion payments from the U.S. company to the foreign related parties, and there are some minimum tax added to the ordinary corporate income tax of 21%. So that rate used to be 10%, but starting in it increases to 12.5%. And there are third and fourth bullet points, FDII and GILTI. These go hands in hand. So GILTI is kind of like a mirror, but FDII is the foreign derived intangible income. So it specifically targets the income from the exports of a product in the US to the foreign countries that is related to the IP. So it provides lower preferential rate, which used to be 13.125%. Starting in 2026, it will increase to 16.4%. On the other hand, GILTI is a mirror of FDII. So it's targeted at the foreign earnings from intangible asset. So if there are IP-related income in the foreign country, then GILTI works like a minimum tax, and it will tax at a 10.5%, but it will increase into 13.125% in 2026. And there are two more business provisions that works in a domestic way, which is a bonus depreciation phase out. So I think it already phased out starting in 2023. It ramped down to 80%. And now it's in 60% in 2024, and starting in 2025, it's 40%, eventually ends in 2027. And there are also Section 199A sunsets. So there's a qualified business income QBI, this 20% deduction for the pass-through income. That's also sunsetting in 2026. So these are the main business tax provisions that are expiring in TCJA. Back to you, Mike.
Great. So Steve, can you advance the slide? Great. So go back one. Thank you. So with understanding what is some of the business tax provisions that are phasing out, let's take a closer look at what President Trump's tax objectives are. And again, this is wrapped up in his big, beautiful bill. As I said before, his number one priority is extending the Trump tax cuts. That is his top priority, but it doesn't stop there. He's been very vocal about trying to eliminate the individual and those Trump tax cuts are individual tax cuts. He's also been focused on eliminating the individual income tax on tips and overtime. But he also has the objective of reducing the corporate rate to 15%. And there is some logic to that, because even though that is very political, the corporate tax rate, whether corporations pay their fair share of tax, et cetera, is very political. There is support for that, because he's able to say that the entire world has agreed that the corporate rate should be 15%. We agreed that with Pillar 2 and the global minimum tax. We've agreed that. So why should the US tax rate be higher than anybody else's? And so there is an objective to reduce the corporate rate to 15%. The other thing he proposes, and this is consistent with tariffs and everything else, is to get manufacturing back to the United States. And he would incentivize that by accelerating our domestic production activities deduction to effectively get the tax rate for domestic manufacturing down to 15%. And then what he also would like to do is to restore some of the business tax provisions that are going to expire. So remember, let's think about this. All of these provisions that Bunsu just talked about, they were pay-fors to get the individual rate down to where it got to in 2017. And now what we're proposing is we want to extend those rate reductions for individuals, and yet we also want to get rid of the provisions that paid for those reductions in individual tax. So that is restoring 100% bonus depreciation. It's restoring the 100% deduction for R&D, and it's moving the interest deduction limitation back to where it was before 2017. And also make our other incentives to bring manufacturing into the United States permanent. All of those cost significant money, and so it's, even though Congress has $5.3 trillion to work with, given everything that's on Trump's wish list, those substantially exceed $5.3 trillion. So Steve, if you could go to the next slide. So the biggest challenge here is making these numbers work. And we have the TCJA of 2017 and the Inflation Reduction Act lessons to see how that juggling will go. Because that's the biggest challenge, is we only have $5.3 trillion to work with. And just even saying that seems ludicrous, to say we only have $5.3 trillion to work with. But given our budget, that isn't a lot of money. And so the challenge will be figuring this out, and how do we make the numbers work? And this is where tariffs come in, because tariffs can be used, in theory, tariffs can be used as a revenue source with respect to trying to make this balance. And remember as well that this balance only has to work at the time we enact the legislation. It only has to work where Congress and the Congressional Budget Office all agree that all of the assumptions with respect to the big, beautiful bill work. Whether those numbers play out over the next 10 years is largely irrelevant to whether Congress enacts this now. And as we know, what we've seen from our experience with 2017, the tax reductions tend to work. But when Congress delegates to the Treasury Department all of the regulatory authority to make the tax increases work to balance out the tax decreases, that's where taxpayers, that's where advisors come in and say, oh no, that's an abuse of authority. That's inconsistent with the statute. So more often than not, what we see is that the tax increases that are designed to pay for the tax reductions, oftentimes they don't raise, the tax increases don't raise the level of revenue that Congress thought they were going to raise at the time the bill was going to be enacted. And so Congress knows that now. Congress knows from their experience from 2017 and from 2022 that the numbers don't necessarily add up. And yet Congress is going to be tasked with making sure that they agree with that assumption. The biggest area where this is going to play out is in the impact of the repeal of the Inflation Reduction Act green energy provisions, because those are a real significant pay for. Those are a real significant revenue source to enable the Trump tax cuts to be extended permanently. So Bumsu, what are those provisions?
Sure. So I wanted to give a little color to the background of these green energy provisions. So during my days in Korea, I used to represent the clients who would like to invest in a US project with all these IRA tax credits. And it was a big hit, and there were a lot of feasibility study to make sure that it works before entering the market. And I think some of my clients actually did end up investing millions and millions of dollars in the US, building out the manufacturing plant and all the supply chain of their products. So one thing that I wanted to note is that on the day of inauguration, the Trump administration actually had an executive order named Unleashing American Energy. It suspended all IRA funding disbursement, and it all created uncertainty. And this was exactly what the current investors were worried about even before the election or even the inauguration. But then one thing just to clarify is that the executive, however, is not expected to affect the statutory IRA tax credit. That is 45 production tax credit, 48 investment tax credit. There are some 45X advanced manufacturing production credit. Those are the credits that the Korean investor heavily relies on. So those are the ones that are in concern to the current investor that are not affected by this executive order. But it also does not impact those direct pay provision, which is under the section 6417, and the transfer elections 16418, which is heavily criticized, not criticized, heavily focused by the Pillar 2 perspective, which will be talked about by Jaeyoung and Hyowon later. Back to you. Right.
So the important thing to note is that even though the executive order doesn't impact all those credits are clearly on the table as bargaining chips with respect to making the big beautiful bill work, because eliminating those credits raises money, and President Trump is not particularly fond of the Inflation Reduction Act credits, in part because they weren't enacted in his administration. But he's not particularly fond of those credits, and those incentives, credits to incentivize investment in green energy. That's just not, President Trump does not care about those. And so those are easy revenue sources. And so, as Bumsu mentioned, these are the credits that Korean multinationals have used to finance, in part, their investment in the United States. And if those credits go away, that totally changes the investment dynamic in the United States. Now, you might say that is completely inconsistent with trying to bring manufacturing into the United States. If we're trying to bring manufacturing into the United States, what we should be doing is incentivizing companies to bring manufacturing into the United States. So there is a related, a related issue that is not, it's related to the big beautiful bill, but it's a totally separate objective. And a number of you may be aware of this, is that the Commerce Secretary has proposed a threshold that says, okay, foreign investors, or any investors, but particularly foreign investors, If you want to invest in the United States and you want to get sort of fast tracked to with permits, environmental permits, etc., then if you invest $1 billion in the United States, we'll roll out the red carpet for you. And one aspect of that red carpet might be these credits. So as a possible compromise for this, you could easily see a Congress saying, all right, we'll allow these credits, but we'll allow these credits if the capital investment in the project is $1 billion or more. And there are a whole host of 100, 200, $500 million projects in the United States, all great projects, all projects that we want, but they're not apparently good enough for the Commerce Secretary. And so, and President Trump, but it's a likely, one likely scenario is that these credits stay, provided that the project itself meets the $1 billion threshold. So that's the lay of the land. And this is really just sort of one side of the picture, because this is just the US side. And so now we'll turn to Jae-young and Hyewon to talk about sort of the Korean side of Korean outbound US investment, and in particular talk about the relationship with Pillar 2. So Jae-young, Hyewon, take it away.
Thank you very much for the very detailed and insightful overview of the Trump administration's tax priorities. Before we move on to discuss the global minimum tax implementation in Korea, I just wanted to comment briefly about the US tax aspects from a Korean investor's perspective. So 3 critical issues demand attention. The first of it is the $1 billion threshold for the fast track investment proposal that you just discussed about. And the second one is the shift toward state level incentives. And finally, tariff and guardrail provisions. So to start with, the $1 billion fast track requirement lacks clarity on the specifics of eligibility, particularly for foreign entities like Korean investors. And they risk sidelining mid-sized Korean companies. Even for projects with big Korean conglomerates like Hanwha, they recently invested in the Philly shipyard expansion, which involves offshore wind components. And even though it's a great project, it falls short of the $1 billion threshold. And also another concern is that if this Korean companies already made a lot of investment in the US, and if this is applied retroactively, such projects would not be able to qualify for the fast track, and maybe costly restructuring may be required. Also, there are smaller players like battery material startups, and they risk exclusion from this fast track investment proposal, which could stifle innovation in sectors vital to US renewable energy. And I guess we will really have to see how this initiative is actually implemented to see if it will really make it easier to deploy capital from a Korean investor's perspective. Another thing that I wanted to mention was that federal tax credits, like the IRA's Advanced Manufacturing Production Credit, are under threat. As the US team described fully, these credits have been under attack from the Trump administration and various Republicans, but these are really pushing Korean companies to look for state programs that provide some kind of incentives to invest in the US. For example, Samsung secured 10-year property tax abatements for its semiconductor fab in Texas, while SK On's Georgia plant also qualify for state subsidies. But the problem is that the state grants still fail to lift ETRs in the US sufficiently because they are treated as globe income. We'll discuss this aspect in more detail right after my comment, but this paradox that US incentives, both federal and state, that are designed to attract investment into the US are now exposing Korean parents to global minimum tax liabilities. This remains a key concern for Korean investors. And finally, tariffs and guardrails obviously complicate strategies for Korean companies that are investing in the US. The US imposed tariffs on Korean battery sales, which raises costs for automakers. And also, the CHIPS Act's guardrail provisions restrict Korean companies like Samsung and SK Hynix from expanding semiconductor operations in China. Samsung's plant in China supplies a significant share of its production, while SK's facility in China is crucial for its semiconductor output. So these rules force Korean companies into pursuing costly dual track strategies, and they really need to balance US subsidies with operational risks in China. So to sum that up, Korean investors need clarity on the $1 billion threshold and also clarity on whether these federal and state incentives will continue to be dispersed as promised. And also they need to come up with resilient strategies to navigate tariffs and guardrails. Next, I'll turn to Chaeyoung to explain the global minimum tax implementation in Korea.
Thank you, Huan. We'll move on to slide page 8, please. So at the outset, I need to note that definitely it is inevitable for us to do otherwise than to touch upon the subject of OECD's Pillar 2 Globe rules in the context of discussing the US tax reform, particularly because, as also Mike and Bromson noted, and over the past few years, a substantial portion of the inquiries that we receive from our clients with regard to Pillar 2 Globe rules actually did arise in the very specific context of various tax credits enjoyed by Korean multinationals in the US. So to briefly recap on the status of Korea's implementation of the Globe rules, Korea adopted the Globe rules into its domestic tax law in late 2022. And both as regards the substantive content-wise implementation, as well as the timeline for doing so, we can assess Korea's legislation as generally following the model rules, commentary and administrative guidances of the inclusive framework rather closely. So for instance, currently, provisions on the income inclusion rule have been in effect since last year, with the due date for the first Globe information return being within 18 months from the end of 2024, that is by end of June 26. Subsequently, provisions on undertaxed payment rule came into effect this year, though I need to note at this point that the transitional UTPR safe harbor proposed by administrative guidance has also been implemented into Korean legislation. So meaning that for fiscal years beginning before the end of 2025 and ending before end of 2026, the UTPR top-up tax will be deemed as zero for M&Es with UPEs in jurisdictions that have a corporate income tax rate of at least 20%. What we are still awaiting and what we do not yet have in place are the QDMTT provisions, but the Korean Ministry of Economy and Finance, that is the ministry that is driving the legislative efforts behind the implementation of the Globe rules, is currently working on also implementing these in the same domestic tax law that is housing the IRR and the UTPR provisions. At the same time also, there are legislative efforts being made also to other domestic tax laws, for instance, the special tax treatment control law, which formulate the efforts to bring certain tax credits for national strategic technologies, such as notably batteries, within the scope of qualified refundable tax credits envisioned by the model rules. So this is being done by potentially revamping deduction type credits towards more direct cash refunds, or also by allowing for transferability to third parties. Thank you.
Thank you, Jae-young, for the overview of the implementation of the global minimum tax in Korea. Can we go to the next slide, please? So I'll talk briefly about how Korea's global minimum tax disrupts US operations of Korean companies, especially in the battery and solar industry. First, why US incentives backfire for these companies. So under Korea's Pillar 2 rules, US tax credits like the IRA's AMPC could reduce subsidiaries' ETRs below 15%, which would trigger top-up taxes for Korean parents. For example, LG Energy Solutions AMPC claims significantly lowered its US ETR and triggered substantial top-up taxes for its parent. SK On and Hana Solutions also face rising liabilities as their US subsidiaries claim these tax incentives. When the AMPC credits are expected to grow, annual liabilities for these Korean parents could escalate. And also, as I mentioned briefly before, Korean companies are facing pressure to pursue dual track strategies, which obviously would strain their margins. So to comply with US guardrails, Samsung halted expansions in China and redirected investments to Indiana. And also, SK On's Georgia plant avoids Chinese suppliers, but sourcing these US-made components increases costs, and it would squeeze profitability for these Korean companies. These fragmented supply chains heighten operational complexity as well. And the state incentives point is also the one I mentioned before. They offer limited relief, while tax abatements from Texas or R&D credits from Arizona do help offset costs. They're not very effective in lifting ETRs above 15%. So the global minimum tax is not just a tax rule, it's a strategic pivot point, and Korean companies must balance compliance agility, which will be explained in more detail by Jae-young later, to mitigate these impact. And they must balance that with operational resilience, like pursuing dual track supply chains. We think that proactive engagement with the Korea's Ministry of Economy and Finance and also with the OECD will be critical to navigate this evolving landscape. I'll turn to Jae-young to explain how these Korean companies may take steps to mitigate some of this impact.
Yes, so tying into Hyun's discussion of the globe top-up taxes on page 10, if you can move on, we are providing a brief overview of a number of discussions that we currently see in Korea as regards attempts to mitigate these top-up taxes. So the first being whether construction and progress, CIP, should be treated as an eligible tangible asset for purpose of the substance-based income exclusion. In fact, currently already some Korean MNEs, UPEs, have taken this position as disclosed in the interim accounts of fiscal year 2024. And in this regard, we are aware that recently the Korean government inquired with the OECD, which provided actually a positive response, namely that CIPs, considering that they relate to tangible assets intended for business use and not held for sale, lease, or investment, should constitute eligible tangible assets for SBIE. So we expect that given this blessing that the Korean government received from the OECD, This interpretation will ultimately also be formally reflected in the Korean tax law, and hopefully this will then also reduce the tax burdens of Korean MNEs that have a significant CIP from high capital investment. Another topic of great interest is whether QDMTT would be eligible for foreign tax credit, because such eligibility for foreign tax credit would be a means to address and also mitigate the potential risk of double taxation caused by QDMTT. And I understand in this regard that the US IRS is taking a positive view on this issue. The Korean tax authorities, however, are yet to provide clear guidance on this point. So for a lot of Korean MNEs, especially those with that are subject to substantial CFC or PE taxation, they are keeping their fingers crossed and monitoring the development of discussions on this point. Similar monitoring and fingers crossing is taking place also with regard to the treatment of QRTC gross up. So this is especially the case for Korean MNEs that were previously promised substantial tax benefits from investee jurisdiction. Some of these investee jurisdictions are considering QRTC gross up as a means of mitigating Pillar 2 tax impact by treating QRTC as taxable income while providing an additional QRTC equal to the tax incurred, that is gross up. So this would have the effect of maintaining the net QRTC amount. But the eyes are now on the OECD, whether this could actually be seen as an attempt to manipulate transactions, to misuse tax benefits in violation of the anti-related benefit rule. So if the OECD should come to take that position, that would result in neutralizing such QRTC gross up and mitigation efforts.
Great. So if we go to the next slide. So how does this all sort of come together? And first of all, Hyoan, we in the US, we share we equally sympathize with respect to the lack of clarity on the $1 billion incentive number. This is something that has been thrown out as an idea, and like a lot of things with respect to tariffs and tax reform in general, there is no specificity at all. And all this is, in theory, is going to come together in the next 3 months, 3 to 4 months. But right now there isn't a lot of specificity, which gets to the point is how do Korean multinationals make decisions now with respect to investment in the United States? And because of all this uncertainty, it's going to have a chilling effect on investment in the United States in general, particularly with respect to Korean investment. And it's particularly problematic from a Korean standpoint because Korea is one of the most advanced countries with respect to Pillar 2 legislation. Korea was out in front of most other countries enacting Pillar 2 legislation. And that now is creating issues, as you've rightly identified, not just with state tax incentives, but also the R&D credit and the impact of the R&D credit on the US effective tax rate and what that does to the Pillar 2 tax. And related to all of this is a negotiation that is starting to happen with respect to the relationship between the US and Pillar 2. And that relationship has largely been viewed from the lens of outbound investment, US investment overseas, and what does this mean? What's the rate? What's the impact of reducing the US rate? What's the impact on the Korean UTPR? But Hyoan and Jae-young, have you correctly pointed out, the impact of credits is equally important on Korean investment in the United States, because as our rate gets reduced, all that's going to do is going to create tax in Korea. But that negotiation, the U.S., you're all very familiar with the U.S. effectively storming out of the Pillar 2 negotiations. And one of the executive orders on January 21st was, we're out of the Pillar 2 discussions. Well, there was an inclusive framework meeting earlier this month in Cape Town, and the United States negotiating team showed up to that. And that was a sign that, all right, maybe the US is still negotiating, but the real issues are going to be around, one of the key issues is going to be around the R&D credit and the treatment of the R&D credit for Pillar 2 purposes. The interesting thing will be is, and I'm an optimist, I believe there will eventually be a negotiation that brings the US into Pillar 2 in a way that basically says that US multinationals, US UPEs are out of Pillar 2. What that means for US subsidiaries of Korean UPEs is another story. But there is a reasonable likelihood, I think, that the R&D credit will be viewed as an acceptable credit for Pillar 2 purposes. I think what that will mean is for Korean inbound investment is that that will then eliminate some of the pressure on the Korean tax rate if the US R&D credit and other credits are viewed as acceptable from a Pillar 2 standpoint. So that negotiation is happening in part as we speak. And so what this means is that while right now the current landscape may be slowing down Korean investment in the US, if there is an agreement, and in particular, if the US corporate rate is reduced, and it's reduced in a way that it doesn't create top-up taxes in Korea, it could be very attractive to be for Korean multinationals to be investing in the United States. But that process will need to play out over the coming months. We'll know first on July 4th what happens with respect to the big beautiful bill. But again, as you Hoyoung and Jiang, you both correctly pointed out, that's only part of the story, because the Pillar 2 treatment of the R&D credit and state tax incentives are going to be major drivers to the willingness of Korean multinationals to continue to invest in the United States. So a lot of uncertainty, and nobody likes uncertainty. No investor likes uncertain. No investor is going to be willing to invest $1 billion into the United States in an uncertain environment. So I think that I know, Bumsu, if you have any other thoughts on this, but I think we're almost at the end of our time.
Right. Just on top of what everyone said, just wanted to point out for the strategies to mitigate the type of taxes. I know it's also important, prudent to consult not only with your tax advisor, but also with your accounting advisor, because I know how these direct pay provision eligible tax credits are treated as above the line item instead of the below line item, which is I think published by the FASB guidelines. So these are, there are turmoils of uncertainties, and accounting boards are also working towards clarifying these items. So just wanted to point that out that, with that treatment, it is possible for mitigation of these global Pillar 2 taxes.
Great, thank you. So I think that brings us to the end of panel 1. So I'll just leave it to me to thank Bumsu, Hyoan, and Jaeyoung. And I think, Steve, we're taking a short break and then going to panel 2.
Right. I think it was extremely insightful and enlightening session, and I hope everyone finds the same, especially the fact that we had an opportunity to have a sneak peek into how the Trump 2.0 tax policy to shape up down the pike, and how the Pillar 2 enacted in Korea will interplay with the U.S. New tax policy to impact Korean investor into the U.S. So now as Michael said, let's take a very brief 5-minute break, just enough to stretch and maybe even grab a coffee or say hello to people around you. We'll reconvene in about 5 minutes for session 2.
Thank you.
Hello, US team, please let us know if you still have technical glitches, then we can control the slide on your behalf.
Yeah, we decided that you were doing it better than we were, so why don't you go ahead?
You bet. Will do. So now we'll begin in session 2. Welcome back, everyone. We're going to move into session 2, focusing on the growing importance of the substance in the international taxation, particularly in the cross-border M&A transaction and global business restructuring. With increasing regulatory demand on demonstration genuine economic substance, this topic is front and center for both tax planning and tax controversy strategies. We're joined by an outstanding group of speakers and panelists. Firstly, the presenter of today's second session will be Tom Kwan. Mr. Kwan is a partner and head of the international tax practice at Lee & Co. He brings over 20 years of experience advising Korean and foreign corporation, investment fund, and other investors on acquisition structuring, cross-border transaction, and fund formation. He is currently ranked tax lawyers by Chambers and International Tax Review. Turning to our panel lineup for topic 2. From Korea side, we're pleased to welcome Yeonu Lee, a senior attorney at Kim & Chang, drawing on her experience at the OECD Tax Treaty Unit in Paris, where she contributed to the BEPS project, including 2-pillar solution. She advises on a wide range of international tax matters. At Kim & Chang, she has represented the numerous foreign and domestic clients in audit, appeals, and litigation across the industries such as IT, digital business, and consumer goods. Also from the Korea side, In-sun Yu joining us for the panel. Ms. Yu currently serves as a Deputy Director of the International Audit Division at the Seoul Regional Tax Office. She previously held key positions within the National Tax Service, including Director of the VAT Division at the Seongnam District Tax Office, and roles in the MAP Division and International Corporation Divisions. She may be perfectly positioned to provide the government perspective on the topic to be discussed in the session 2. From the US side, we're honored to have Bart Stratton. Mr. Stratton is the M&A West Region Leader at PwC US. He has over 23 years of experience advising on domestic and cross-border merger and acquisitions, corporate reorganizations, and federal income tax planning for multinational corporations. Prior to his current role, Bart was a partner in PwC Washington National Tax Office. He has advised a client across a wide range of the industries, including private equity, fintech, entertainment, and technology. Last but certainly not least, we're honored to have Mr. Steve Weert from the US side, major market leader for KPMG's international tax practice in the Pacific Southwest region. Steve brings over 20 years of experience advising multinational corporations on cross-border transactions, global restructuring, and international tax planning. He has extensive expertise across the industry, including technology, life science, and telecommunication. Without further ado, let's dive into session 2. Tom, the floor is yours.
Good morning, late good afternoon. First off, I wanted to say that this is a true honor to present at the first IFA Southern California Korea Joint Seminar. I also want to thank everyone for taking their time from their busy schedule to participate. Second, I know that some people do not like it when someone reads from the slide deck, but this presentation is rather detailed and covers a number of complex topics. So I will generally be following what is written on the slide deck. Apologies in advance for that. Next slide, please. Next slide, please. Go to the introduction. In the context of international and cross-border M&A transactions, the concept of substance is critically important. This is just as true from a Korean tax perspective. In this session, we will briefly review some of the key concepts relevant to substance from a Korean inbound tax perspective, with reference to the OECD Model Tax Convention where applicable. We will also discuss some recent Supreme Court cases of interest. As an aside, please note that the importance of substance in the context of improper use of tax treaties will also be addressed as subject to in the 2025 IFA Lisbon Congress, scheduled to be held in the fall of this year. Next slide, please. South Korea is a member of the OECD, and many principles and concepts from the OECD Model Tax Convention and commentaries have been adopted into the Korean domestic tax law and practice. This is also true of the concept of beneficial ownership. In the OECD commentary, beneficial ownership generally refers to the idea that the recipient of the income must be the actual owner who enjoys the economic benefits of that income, and that it is not merely a nominee, agent, or conduit that passes the income to another party, such as in the case of a back-to-back financing arrangement. OECD Model Tax Convention Articles 10, dealing with dividends, 11, dealing with interest, and 12, dealing with royalties, provide that the reduced withholding tax rates in the treaty are granted only if the recipient is the beneficial owner of that income. In contrast, substance refers to the economic reality behind an arrangement. It focuses on whether the recipient has real business activities, decision-making authority, employees, risks, functions, in other words, whether the entity exists meaningfully beyond just legal form. In summary, we can say that under the OECD commentary approach, especially after 2014, beneficial ownership and substance work together as tools to prevent treaty abuse. While beneficial ownership focuses on who ultimately benefits, substance focuses on whether the structure reflects genuine economic activity. Next slide, please. As for Korea, before 2018, the Supreme Court tended to treat substance as essentially the same concept or as a component of beneficial ownership for purposes of tax treaty application in its decisions, rather than as two separate concepts. However, since the CJEM decision, which was issued in 2018, the Korean Supreme Court has applied a two-step analysis. And a foreign taxpayer who claims benefits under a tax treaty with Korea must meet two standards. First, it must be the beneficial owner under the treaty. And second, it must have sufficient substance to avoid denial of tax treaty benefits under domestic general anti-avoidance rule, or GAR. The decision involving a Korean company, this decision involved a Korean company paying dividends to an intermediary holding company in Hungary. The ultimate parent was in the US. The issue was whether the Hungarian holding company was eligible under the Korea-Hungary tax treaty for the reduced withholding tax rate of 5%. The Korean Tax Authority, or NTS, attempted to deny this reduced rate and instead applied the 16.5%, a much higher rate under the Korea-US tax treaty. The Korean Supreme Court ultimately ruled that the holding company in Hungary qualified as the beneficial owner since it had no legal or contractual rights to transfer the proceeds, contractual obligation to transfer the proceeds to the US parent, and the holding company had sufficient economic and physical substance in Hungary, and hence there was no discrepancy between actual substance and form in this structure. Next slide, please. So what is an appropriate level of substance for a foreign entity to be eligible for tax treaty benefits in Korea? This is a facts and circumstances test, but the Supreme Court has considered, among other things, a number of factors. whether the entity makes management decisions and bears business risk with respect to the investments, exit, or distributions from Korea, whether the entity has physical substance such as actual office and employees, whether the entity has other businesses or operations in the country of residence, whether the entity has investments solely in Korea or also in other jurisdictions, whether the entity pays taxes in that jurisdiction, and so forth. The NTS has also generally accepted these factors in determining substance of a foreign entity in our experience. Next slide, please. Finally, I wish to mention here the so-called look-through approach. Based on the concepts of beneficial ownership and substance that we just discussed, the NTS has historically adopted the look-through approach in practice, where a foreign investor uses holding company structures without sufficient substance in Korea, for investments into Korea, excuse me. Under this approach, if the foreign company does not have sufficient substance to be respected as the beneficial owner or otherwise eligible for tax relief benefits, it could be disregarded and looked through. Additionally, all the entities in the ownership chain without sufficient substance will also be disregarded, and the NTS will trace up to what it deems the ultimate beneficial owner of this Korean source income. This approach was historically controversial and the basis for many disputes between the NTS and foreign taxpayers, especially in the context of foreign private equity investment into Korea. Since many foreign private equity funds and other fund vehicles are often hesitant or unable to disclose all their ultimate investors. This approach for foreign funds was codified into the Korean domestic tax law in 2019 and is often referred to as the OIV regime or OIV rules. The published regulations and the forms have greatly reduced many of the controversies in this area, but some questions still remain. Next slide, please. Substance is also the foundation of the Domestic General Anti-Avoidance Rule, or GAR. Under Korean GAR, which is also referred to as the Substance of Reform Principle, the NTS is allowed to disregard the legal form of a transaction or transactions and instead assess tax based on the actual economic substance of the transaction, or at least what the NTS thinks is the actual economic substance. In other words, true substance of the income, transaction, or act should be the basis of taxation, regardless of the legal form adopted by the taxpayer. The purpose and rationale for GAR is to prevent tax avoidance through artificial or abusive structures and to ensure that taxation reflects economic reality or commercial substance, rather than mere documentation and contractual structures. GAR is codified in the Korean domestic tax law. Next slide, please. Next slide, please. Oh, sorry. It's fine. Yes. GAR may be applicable in some of the following situations. Sham transactions. If a transaction is lacking in economic substance and is affected only to attain tax benefit, it can be disregarded. Recharacterization. Even if a transaction or a number of step transactions are legally valid and complies with the law, the NTS may recharacterize if in substance differs from the form. Beneficial ownership. As discussed earlier, if the legal taxpayer lacks substance, the NTS may attempt to look through to the ultimate beneficial owner in the tax treaty context. Who has the burden of proof with respect to proving tax avoidance? There is an ordering rule in Korea. In principle, the NTS has the burden of proof with respect to application of GAR. However, if the tax liability to Korea through a circumvention transaction is not more than 50% of the amount calculated based on the transaction's actual economic substance, then the burden of proof shifts to the taxpayer, and the taxpayer must prove that there is a legitimate business reason for that transaction. Finally, I wish to note that it is important that that taxpayers are aware that many foreign taxpayers, have successfully challenged the application of GAR and recharacterization by the NTS by producing evidence that the structure or the arrangement has genuine business purpose and sufficient economic substance. Next slide, please. A few other notes on GAR. PPT, Korea adopted the principal purpose test for 50 out of its 94 tax treaties as part of its ratification of the multilateral instrument. PPT is a general anti-abuse rule that allows tax authorities to override tax treaty benefits, even if formal documentation such as a tax residence certificate is submitted by the taxpayer. Most tax practitioners and scholars in Korea believe that the concept of PPT is substantially identical or virtually the same as Korea's domestic GAR. Limitation on benefits. In contrast to PPT, limitation on benefits, or LOB, requires the taxpayer to satisfy certain ownership or business activity requirements to claim tax treaty benefits. LOB generally does not appear in Korean tax treaties, perhaps with the exception of the Korea-US tax treaty, and is generally regarded as not compatible with Korean GAR or the look-through approach. Next slide, please. Now I would like to discuss a couple of recent Supreme Court cases dealing with substance in the context of cross-border transactions into Korea. Next slide, please. Thank you. One slide up. Page 11. Thank you. First, a case involving indirect transfer of a Korean company. Generally, under Korean domestic tax law, a transfer of Korean company shares will result in Korean capital gains tax, which is a type of corporate income tax, and securities transaction tax, or a type of transfer tax. However, there is no specific tax law provision in the domestic law that deals with the case of an indirect transfer of a Korean company, shares. There is also no reporting requirement either, and this is in contrast to India or China that you may be familiar with. However, in a 2016 tax ruling, the NTS did state that it could tax such an indirect transfer under GAR based on the specific facts and circumstances of each transaction. In this context, I wish to discuss a recent trial court case involving such an indirect transfer. In this case, a Hong Kong company and a Singapore company invested 50-50 as joint venture partners in a Korean entertainment complex in Jeju. The Singapore company's investment into Korea and Target was made indirectly through an intermediary holding company consisting of a BVI company and another Singapore company. The Singapore company exited this JV structure by selling the shares of the BVI company to the Hong Kong company rather than selling the shares of the Korean Target directly. Next slide, please. So in this structure, you can see that Hong Kong company acquired the BVI company rather than the Korean Target directly. The NTS assessed Korean capital gains tax and securities transaction tax on the Hong Kong company, the purchaser. The NTS argued that this should be taxed as a deemed transfer of Korean company shares. The tax tribunal, an administrative review board, affirmed this assessment, and they determined that the two intermediary holding companies, the BVI company and Singapore company 2, did not have meaningful substance. Also, they said there was no other purpose of indirect transfer other than tax avoidance. However, on appeal, the trial court reversed and ruled in favor of the taxpayer. Next slide, please. The trial court's grounds for judgment in favor of the taxpayer included the following. GAR should not be interpreted overly broadly to overturn the basic principle or the basic Korean principle of taxation based on the tax law. In other words, a specific taxing right must be prescribed in the tax law. Since there is no explicit tax law in Korea, unlike in China or India, which permits taxation of indirect transfer, the application of GAR should not be applied to create a new taxing right to the NTS. The court also stressed that the taxpayer may choose one of several legal arrangements to achieve the same economic purpose, and the NTS should respect the legal arrangement chosen by the taxpayers unless there are special circumstances. Next slide, please. Please note that the trial court did not discuss substance at the level of the two intermediary holding companies in its decision, and it was not determinative of the court's decision. We understand the NTS has appealed this decision to the Korean High Court, the appellate court. Next slide, please. Another interesting cross-border M&A decision was issued by the Korean Supreme Court in 2022, and it deals with a cross-border business reorganization. In this case, a US company made an in-kind contribution of the shares of its 100% owned Korean subsidiary, KoreaCo, to its Dutch subsidiary. So afterwards, Korean subsidiary became 100% subsidiary of the Dutch subsidiary. Although capital gains tax would normally apply to this kind of in cross-border in-kind contribution, it appears to have been exempted under the Korea-US tax treaty. However, the US parent did pay securities transaction tax in relation to this in-kind contribution. Subsequently, Korean subsidiary made dividend payments to the Dutch holding company, the Dutch Co. The dividends were subject to the reduced 10% withholding tax rate under the Korea-Netherlands tax treaty. However, during the tax audit, the NTS denied this and imposed the higher 16.5% rate under the Korea-US tax treaty, effectively looking through the Dutch company. Next slide, please. In response, the taxpayer, the Dutch subsidiary in this case, claimed refund of the securities transaction tax, arguing that if the NTS were to deny the validity of the in-kind contribution under GAR, then the taxpayer should also be eligible for refund of the STT, since the NTS disregarded the in-kind contribution. The NTS rejected the refund application, and the taxpayer appealed. The Supreme Court ultimately affirmed the lower court's decision and ruled the in-kind contribution by US parent lacks substance, as it was principally structured to take advantage of the favorable Korea-Netherlands tax treaty. However, the legal form of the transaction was still recognized and subject to securities transaction tax, regardless of the recharacterization under GAR for tax treaty application purposes on the dividends. We have come to the end of my presentation. I hope it was interesting. Thank you.
So thank you very much, Tom, for the insightful presentation. And I mean, Tom has already covered a lot of information, and actually, there are much more Korean tax cases related to substance or beneficial ownership or treaty abuse. But probably I'll just touch upon several points to what Tom has mentioned. So I think from the U.S. investor perspective, it is known that in the Asia Pacific area, for instance, India or Australia might be notorious for their aggressive applications of GAAR or substance over form rule. But I think Korea also has a tax environment where there are a lot of applications of substance over form rule or GAAR. And sometimes this kind of substance over form rule or restructuring from a tax authority perspective not only happens in a corporate income tax context, but also in this context of indirect tax as well. For instance, if the Korean tax authority finds a permanent establishment of the U.S. investor in Korea, then they sometimes restructure any cross-border transactions into a domestic one and levy a lot of VAT as well. But I think the Korean Supreme Court has quite a balanced view because there are multiple cases around beneficial ownership or tax treaty abuse, but then there are a lot of cases where the taxpayers won. So, for instance, I think what Tom has presented, the CJE&M case was one of the leading cases regarding the beneficial ownership issue. In that case, the income at issue was a royalty paid by CJ to the U.S. Viacom Group, which provides a lot of video content in the brand name of Paramount. And actually there, in that case, the substance of the Hungarian holding company was respected. And I think in multiple Korean tax cases where the issue was about the industrial investors from foreign countries, a lot of substance was respected for the holding companies. So for instance, there is a Carrefour case where a French retail company invested in Korea through the Dutch holding company. The court respected the substance of the Dutch holding company because it was doing businesses and it was making decisions, and there were offices and human resources as well. And another case called Total case, where another French energy company invested in Korea through the British holding company. And in this case, dividend was at issue, and it was a JV structure, but the substance was also respected. So I think from an inbound investor's perspective, I think it is always strategically recommendable to maintain genuine economic activities and substance in the holding companies, so that you can have good commercial reasons, and the structure itself would not look like that the principal purpose of the transaction is benefiting from the tax treaty benefits. And another uniqueness about the Korean GAAR is that is about the burden of proof. As Tom has righteously presented, recently there was an amendment to the Korean law, and the burden of proof might be transferred to taxpayers in certain cases. So I think it is because sometimes the National Tax Service finds it difficult to collect evidence to show some sort of tax-oriented purpose of or intention of the transaction, because it is a subjective requirement, and mostly the cross-border transactions relate to a lot of foreign communications, and sometimes it is difficult to collect information during the tax audit. So I think that's why this provision was introduced. So it is always recommendable to prepare for certain evidence to support the commercial reasons for setting up an entity in certain jurisdiction and so on. So that would be about the GAAR. And Tom also mentioned two recent cases about indirect transfer and business reorganization. And I think such decisions from Korean courts are also not does not deviate from the global trends, because I think the indirect transfer case relates to it is very similar to the Indian Vodafone case, where the taxpayer won in the similar indirect transfer case. And I think in the business reorganization case, the tax authority won because I think it was pretty evident that the taxpayer intended to abuse the tax treaty between Korea and the Netherlands. So if we go to the next slide, I have prepared another case. This is not about beneficial ownership case or substance over formal, but it is one of the high-profile leading cases in international tax that relates to Korea. And there was a recent decision only last week about the final decision for the civil case. So I just wanted to briefly touch upon the Lone Star case. This is about the case where Lone Star invested in Korean targets through multiple SPCs through Belgian holding company. And actually, it dates back to like 20 years ago, where the U.S. funds and Bermuda funds bought several Korean targets and sold targets in 2007. And apparently there was a huge amount of capital gains, and there was a huge amount of tax assessment saying that the Belgian holding company does not have any substance. So the Korea-Belgian tax treaty cannot be applied, and the US investors or the Bermuda investors were the beneficial owner. And then after that, actually, the taxpayer, the Lone Star, won the tax case in the Supreme Court in 2017 with the permanent establishment issue, because the court found that there was no permanent establishment of any U.S. Investors because there were, the main activities were done outside of Korea, but not in Korea. And if you go to the next slide, so actually, the Korean government had to refund the huge amount of tax, but actually, it did not fully refund, but only partially refunded the tax amount, given that there was an issue between whether the right to claim for the refund would belong to withholding taxpayer, which was the Lone Star in this case, and or the withholding agent, which was the buyer of the Korean target. So, so the taxpayer filed a civil lawsuit against Korean government, and actually, the year before and last year, the court dismissed the claim based on the fact that the right to refund claim belongs to the withholding agent. But last week, the Supreme Court overturned the lower court's decisions, saying that the taxpayer or the withholding taxpayer has the right to refund claim. And although this is a civil case, again, filed by a withholding taxpayer to the Korean government, but the Supreme Court, it's a civil case, but it refers to the substance over form rule, because among the reasons, it states that the corporate income tax was levied not based on the fact that the intermediate holding companies were taxpayers, but based on the fact that the upper tier investors were taxpayers as substantive owners, which means that the tax assessment in the Lone Star case was made based on the fact that not the Belgian holding companies, but the upper tier investors, who were the US or Bermuda investors, were the substantive owners. So although the tax case did not explicitly mention the beneficial ownership issue or the substance issue, but only ruled about the permanent establishment issue, it assumes that in the financial investor context, it is it is more dangerous to it is riskier that the Korean tax authority might look through the structures so that the final investors would be the beneficial owner. Well, as Tom mentioned during the presentation, the Korea has introduced OIV filing compliance rules. So as long as the financial investors comply with these rules, there is a tax certainty, because anyway, the beneficial owner would be the investor who actually bear the economic risks. And I think in such a tax certain, at least there is a minimum tax certainty from a U.S. investor perspective because there would be less risk of, like being this issue disputed along the litigation. So that was about perspective from taxpayers in Korea, and I'll just hand over to Ms. Yu from National Tax Service to hear more about the perspectives from Korean tax authorities.
Good morning and good afternoon, everyone. My name is Insun Yu from the National Tax Service. First of all, I'd like to thank both Tom and Ms. Lee for their very insightful presentation and comments. I would like to make a very brief comment. First of all, on the business reorganization case that Tom had explained, which I think is worth mentioning because from a tax authority's perspective, the ruling was consistently in favor of the NTS taxation at all three levels of court. I'd like to focus on the Dutch holding company that was established in between the ultimate U.S. parent and the Korean company. In this case, the first of the two tests established by the CJ-ENM case, which Tom had also explained, which is the beneficial ownership test, wasn't an issue. It was a second test, which is who the substantial owner of the proceed was reviewed in detail. In this case, the recipient of the dividend and deemed dividend, the direct recipient was the holding company in the Netherlands, which was established in the exact same year the business reorganization took place. The courts determined that the holding company was a conduit by applying the look-through approach, and the purpose of the holding company was for reducing the taxable income. At first glance, this decision appears to be inconsistent with the recent trend in our court rulings, which is becoming more acceptive to the substance of intermediary holding companies, even if they lack a little physical presence, as long as they function and they have been functioning in prior years as traditional holding companies. But in this case, the Dutch holdco, the NTS found very little physical presence, such as very little people resources or activities that appear on its financial statements. And along with that, the holding company was established less than 6 months prior to the business reorganization was planned. And these were the factors that the Korean courts considered in disregarding the holding companies. So if you look at the facts and details of the case, the court decision here doesn't stray too far away from the recent trends in relation to the Korean courts holding rulings on holding companies. I'd like to point out that even with seemingly similar facts and circumstances, sometimes the court rulings seem to differ. However, as we get more such case decisions, it'll provide the tax authority, the NTS, with a clearer guideline on taxation. And this eventually will provide a more predictable and certain, will provide more predictability and certainty to both foreign and domestic taxpayers. I would like to touch upon the Lone Star investment case. I agree that this is one of the most high profile and controversial cases in Korea. There was a number of other taxations regarding Lone Star. The NTS lost in some cases, such as the case explained by Ms. Lee on this slide. But there were other cases in which we won, particularly in the instance where the principle of substance over form was applied in attributing income to the beneficial owner. The significance of the Lone Star taxation is that it allowed the Korean government to find gaps and ambiguities in the tax law so that over the years we were able to close those loopholes, such as by introducing the OIV filing compliance requirement in the tax law. These amendments provide, we hope, better certainty and consistency for both taxpayers and the NTS. Over the years, the many court decisions around the application of the substance over form principle have accumulated, and cases like these serve as a guidance for our tax auditors as well as for investors alike. On a final note, our top management at the NTS has always emphasized that we view foreign investors as partners in our economic growth, and as such, we make sure that we treat both foreign and domestic taxpayers equally in applying the tax law. The bureau that I work for is responsible for audits of taxpayers who are based in Seoul and who engage in international transactions. At the audit selection stage, we apply the exact same criteria and standards that are applied to domestic. We apply the same criteria and standards to both foreign and domestic taxpayers in making audit selections. And during the tax audit, we do our best to make sure that our taxation decisions are strictly based on domestic tax laws, prior court rulings, and tax treaties, and that we play within the widely accepted international taxation standards. Because we want to stay out of tax disputes as much as our taxpayers do. So we respect the structure of the taxpayer transactions when there is a legitimate business purpose and when it's justified. And we question schemes only when they seem abusive or seem to have little or no business purpose other than to reduce tax liability. The message that I'd like to deliver is that from a tax administrative standpoint, we want to make a business environment that is friendly for our foreign investors. Thank you.
Thank you. I think we now go to the to Southern California, sunny Southern California.
Okay, great. Tom, just so we're aligned for everybody on the line, how much time do we have?
We have 10 minutes.
Okay, great. Thank you. So thanks everyone, and we're really excited to have this opportunity to present to those in Korea as well as those joining us here in the States. Tom's presentation and the subsequent comments have really focused on inbound issues, right, with inbound investment into Korea, right, which is important, you know, both from a Korean perspective and from the foreign or U.S. investor perspective. What we thought we would do is take that same paradigm, inbound investment into Korea, and look at it from the perspective of a U.S. buyer and some of the things that a U.S. buyer is going to consider, and in turn, some of the things that the Korean target, or in the future Korean subsidiary now of a U.S. parent, are going to have to think about. One area is the U.S.'s control of foreign corporations, right? And we're looking at this in the context of substance and where the U.S.'s control of foreign corporation rules require substance in order for income to be taxed at a preferential rate. And so just to kind of lay that out briefly, the U.S. does not have a deferral regime anymore. Prior to 2018, we had a deferral regime, which meant that foreign subsidiary, so in this case, Korean subsidiary income of a US parent would not be subject to US tax until it was actually repatriated back to the US through a dividend. Today, we do not have that same regime. Today, the income of a Korean subsidiary of a US company is immediately subject to US tax. The only question is really whether that tax rate is the full 21% US corporate tax rate or a reduced rate that applies to what we refer to as global intangible low tax income or GILTI. That reduced rate is currently 10.5%. It's been 10.5% since 2018. It will, absent the Trump administration's ability to extend, it will increase to just over 13% next year. So maybe we can go to the next slide. Okay, so by and large, you would like income to be taxed at the GILTI rate if possible. There are times, especially if you're in a better foreign tax credit position, or there are a number of different instances where you may prefer subpart F, but by and large, just because of the lower rate, you generally like to be in the GILTI rules. So in order to, you can think of the GILTI rules as the default, as long as the Korean income does not fall into one of the categories of subpart F income, then it'll be taxed at the GILTI rate. Now, in order for that income to qualify for the GILTI rate, in other words, to fall outside of subpart F income, that's where we turn to some of these concepts of substance, because the CFC rules in the US look at different types of income and then look at the type of activities that are performed by the CFC, by the foreign subsidiary, to determine whether it'll be caught by the subpart F income rules or whether it can be treated as GILTI. And we've put on this slide a few examples. Sales income of a CFC, and we're going to show an example of this in a minute, but a sales income of a CFC, if there is an intercompany transaction somewhere in the supply chain, that income is going to be taxed as subpart F income rather than GILTI, unless the CFC either actually manufactures the product that it is selling, or it performs a substantial amount of activities around the manufacturing process that allows it to be treated as having enough substance around that sale of product to escape taxation under subpart F. Similarly, with services income and royalty income, there are tests that look at the substance of the CFC, in this case, the Korean company, that is earning that income, to determine whether that income should be subject to tax at the subpart F 21% level or at the GILTI level at 10.5%. Bart, maybe you want to talk a little bit about what you look at from an M&A perspective.
Yeah, I mean, I think one of the things to keep in mind is, it's interesting to me that a lot of the conversation we're having today around substance and the rules and the different criteria that the courts and various tax authorities use to determine substance are very similar between Korea and the US. I think both countries are aligned to looking at targeted activities that are considered substance. What kind of functions are being done in the country, what kind of employees or other fixed place of business is being done, and all going through the business rationale and business purpose for why we're establishing entities and why we're using these entities to either be holding companies or to be included in the supply chain through the various different levels. From an M&A perspective, when I'm advising clients in a diligence framework, we're definitely looking at substance, and we're kind of putting on a lens as though we are the tax authority and looking at the various supply chain, looking at the various different income flows, evaluating treaty benefits and those to really advise our clients on looking at potential risk areas. Especially, I think there's a tendency of U.S. multinationals to go around and look for a lower rate and to try and rely heavily on treaties to reduce the overall effective tax rate of the various activities. And so oftentimes we're looking at activities that are being done in these various jurisdictions, and our clients oftentimes want to know, how much substance do I have to have in a particular entity or a particular country to qualify for treaty benefits or to qualify for a lower tax rate and some of these other things. So I think, Steve, kind of what you're saying is, it's interesting to me that there's a lot of harmony between, the Korean set of rules and discussion we've had and the U.S. federal income tax criteria here in terms of kind of what the various parties are looking at in terms of substance.
Yeah, no, I think that's a great point. Maybe we can go to the next slide and we can look at an example. And I think, this is really intended to illustrate that while this issue of substance is always today overlaying, everything that you do from a planning perspective, when you as a Korean company are acquired by a US company and are now subject to the US CFC rules, some of the specifics of the US CFC rules may cause the Korean company to have to deal with something that they've never had to deal with before, right? In this example, we have a Korean company that has always operated, the way it wants to operate. It has engaged a third-party contract manufacturer in China to manufacture product. It purchases that product, it sells that product to its customers, and that's the supply chain, right? And there's never been an issue with that. Well, suddenly the Korean company's now been acquired by a US parent, and now the CFC rules come into play, and the US parent has its own distribution network for Europe. And as a result of that, the Korean company is now going to start making intercompany sales to its Dutch sister company. This brings our CFC rules into play and requires there to be a certain level of activities around the manufacturing process in order for the Korean CFC to qualify for the lower GILTI rate rather than the top subpart F. Maybe we can flip to the next slide. And I apologize moving fast here, but just moving away from the CFC issues, we thought it was also important to think about from the perspective of a Korean company acquired by a US parent, the transfer pricing aspects of what the US parents group may want to do with the Korean subsidiaries IP going forward, right? And so issues around where the substance is in Korea, what level of substance there is in the US around how that IP is going to be used going forward, and what levels of substance there are around how the IP may be used in other places within the US parents group. Maybe we can flip 2 slides briefly, and we'll close with an example. Here we have US company acquires Korean company. Korean company has always operated its own, owns its own IP, developed the IP, et cetera, and has always operated as described before. The US company has a cost sharing structure in place with its Dutch subsidiary, right? What the US company often wants to do is move that Korean IP into its cost sharing structure. And so a lot of the questions there are going to be around, 1, how does that IP move? And then 2, is there sufficient substance in the US company's IP structure, particularly in the Netherlands, right, for the Korean tax authorities to respect the transfer pricing going forward? I don't know, is there anything you wanted to add, Bart?
No, I mean, I think, one of the things that is a very popular, we talk about this concept of a 338 election, and you may ask, because of the GILTI regime, normally when you acquire the stock of a CFC or an entity that becomes a CFC, there's no step up in the inside basis vis-a-vis the actual assets of the company. So normally there would be a normal tax charge to extract the IP out and get it into the US, or to move the IP. But in our US tax system, we have what's called a 338G election, which treats it as though it is effectively an asset acquisition from a US federal income tax perspective. And that election can be made that doesn't impact generally the sellers, and it doesn't really impact the Korean statutory overlay in terms of what happens from a local country perspective, but it does give us a step up in the asset basis, which allows us to move the assets around in a very tax efficient way, because now we have a fair market value basis in that IP and related, going concern value that we can allow us to move that IP up and around to get it where we need to go.
So Bart, Steve, if there is a cost sharing structure in place, this isn't an option. If there's a cost sharing structure in place, you have to move that Korean IP, which means that absent some other planning, you're potentially going to be triggering Korean tax in addition to potentially triggering US tax.
That's right.
So this is a key diligence item whenever you have an acquisition of a Korean target by a US parent with a cost sharing structure, which every US multinationals have a cost sharing structure.
Yeah, so you've got to evaluate, if there's, like in this example, we're saying that Korea has net operating losses that is able to offset that. So, but you got to diligence those to see, how comfortable do we feel about those losses, or just understand what the tax cost is. It could also get into an allocation of what is the IP worth and the value. And most valuations are more of an art than a science. And so, you get into pressure on, how you value the IP and those type of things.
Because you could, given that with the tax cost, if you don't factor that into the purchase price, and you find out later that you've incurred a bunch of tax, you're basically paying for the deal twice.
Correct.
So maybe with that, given the short period of time, I think we've reached the end of our presentation, and I think we just kind of leave you with the message that that if you're a Korean company and you're being acquired by a U.S. company, be prepared for some of these changes, some of these things that U.S. companies often either have to deal with because of the CFC rules, or will require you to deal with because they have cost sharing structures or other IP planning in place that's now going to involve the Korean company. Maybe I'll turn it back to Tom.
Thank you, Steve. Thank you, Bart. So now we'll turn it back to Steve Kim to wrap up.
Thank you, speakers and panelists, for session 2, and also thank you all for staying engaged throughout this discussions. As we move toward the closing, let us briefly reflect on the insights shared today, from macro level policy trend to practical consideration for Korean investor planning and outbound investment in the United States. And also from the trend of Korea's application of substance over form principle to its implication for current and future US and other investors into Korean market. So we pretty much cover both inbound and outbound for US and Korea from different angle. So today's discussion has certainly provided us with a valuable insight, and session like this serve as a timely reminder that cross-border tax is never merely about numbers. It's about the anticipating change, managing complexity, and planning strategically for the future. To officially close today's program, let's hear the closing remark from Mr. Jung-Hong Kim, the Vice President of the IFA Korea. Mr. Kim is a leading partner at the Lee & Co. Tax Practice Group, specializing in international tax and customs. Prior to joining the firm, he held several influential public sector roles, including head of the International Tax Division at Ministry of Economy and Finance, case analyst at Supreme Court of Korea, and director of the tax program at OECD Tax Policy Center. With that, Mr. Kim, over to you.
Thanks, Steve. Since we are over time, I'll make it short. On behalf of IFA Korea branch, my thanks go first to all speakers and panelists who made the seminar a wonderful and insightful exchange of views. Also, I thank all the participants online and offline for their attention. As mentioned at the opening, this format of Trans-Pacific seminar is first of its kind, and I hope we could develop further this format into the next seminar in these turbulent times of international tax. With that, the session is adjourned. Thank you very much.
With that, let's gavel down today's discussions, and thank you all once again for your time and thoughtful engagement. We look forward to gathering again for another meaningful and timely conversation in the near future. Thank you.